Welcome back to Real Estate 101. I'm your host, Joe Terceira, and today we're going to continue our discussion on mortgage financing, specifically first-time homebuyer financing, and I'm pleased to be joined once again by Eva Zaba of Centum Way to Save. Eva, welcome back to the show.
Thank you for having me.
So Eva, tell me, as a first-time homebuyer, before going to a lender for a pre-approval, why is it important to know your credit score?
Well, most of the people don't know exactly the credit score. They know if they have a good credit or bad credit. Most of the people who have a bad credit, they know they have a bad credit.
Right.
But people who have no problems with paying their bills on time, who have some credit cards, who got car loans, they know that they have a credit, and they basically don't know if they have a good credit or excellent credit. So if they are not in trouble, then most of the time the credit is good. So most of the people don't know exactly the credit score, what they have, but if they have a basically idea if they have a good credit or not so good credit, that's good enough to start looking for a new house.
Okay, so let's say a client gets a pre-approval from a lender. How long is that pre-approval usually good for?
Well, our pre-approvals are good up to 4 months, up to 120 days.
Okay. So let's say the lender on the pre-approval provides the borrower with a rate of 3% hypothetically, and the borrower purchases a home in 2 months' time and the rate comes down. What rate does the client get?
Well, it depends. If that lender offer lower interest rate at that time, then the borrower will receive a lower interest rate.
Right, even though the pre-approval was a higher rate.
Yes.
So Eva, for some of our viewers that don't know, when is the mortgage commitment usually signed?
The mortgage commitment we're signing when we applying for a mortgage. So when we take first we apply for a pre-approval. And then when we have a property in mind, when we are purchasing the property, then we applying for a commitment. And the banks receiving the information, reply with the commitment, and then we sign the commitment after we receive paperwork from the bank.
So I guess in other words, it's when an offer is made and accepted, usually conditional on finance, that's when a mortgage commitment is done.
Absolutely.
Okay. So let's talk a little bit about what is TDS and how it's calculated.
Well, we have two calculations. We have a TDS and GDS. Portion of TDS is a GDS. Right. So let's start it with GDS. GDS is a percentage of your income that bank will allow that to go towards your mortgage payment.
Right.
So right now, from your income, 39% of your income can go towards your mortgage payment.
And that's like a cap?
Yes.
Okay.
Okay, but that's a mortgage payment, that's taxes, that's heating cost, and if someone's buying a condo, half of the condo fee. That is a calculation for GDS. And then TDS, it's GDS, so all the cost of mortgage, of taxes, condo fee, and heat, plus your other expenses. So credit cards, car loan, personal loan, the loans for school. So those costs goes into the TDS. TDS is a total debt service. Yes.
Right. Okay. Now, so what is the ratio of TDS that lenders will normally approve?
Well, for GDS, we have 39%
right.
on a 25-year amortization, and TDS, it's 44%.
44?
Yes.
Okay. So what's the difference between an A lender and a B lender?
Well, we have, yes, we do have qualification for A lender and B lender, and they service the clients with the different needs, basically.
Right.
So a lender, it's a major institution, major bank, and they will need all the qualification from the client. So they will need a client with the very good credit. They will need a client who can prove the income. And this is a big one. We need the pay stubs, we need the letter of employment, we need the stability at work. So this is something then the A lender will be looking for. A B lender, it's a financial institution who can look beyond that, who can look for someone who's self-employed, who is a plumber or a hairdresser, and the hairdresser most of the times doesn't show on their taxes the tips that they receive.
Right.
So stuff like that, they just serve you know, different needs for a different client.
Right. Now, but there are benefits of going with a B lender.
There are lots of benefits, and it doesn't mean that they will receive a worse interest rate than the A lender.
Right. Okay. So when shopping for a mortgage, is it better to work with a mortgage agent, or is it better to just walk into your local bank?
Well, when you walk into the local bank, there's nothing wrong with it, but the person who works, they will provide you the service of that one particular bank, and they will check your credit, and you will receive the service and the program that that bank will have available for you. If you work with the mortgage agent, we have 40 banks, over 40 banks. We can shop around for you. You will not have to check your credit with every bank, because we pull up your credit once, and we can provide that information to different banks. And you know, there is a situation then the local bank will not be able to provide you with the mortgage, or they will not offer the discount rate that the mortgage agent can.
So for today's final question, for one of our viewers that may want to work with you or a mortgage agent, what does it cost them to work with a mortgage agent to do some mortgage shopping?
Well, the clients have nothing to worry, because the lenders are paying us to provide the service to the client.
Perfect. Eva, thanks very much for coming on today's show.
Thank you for having me.
If anybody has any more questions or would like more information on mortgage financing, they can get in contact with Eva Zaba at Centum Way to Save. I'm your host, Joe Terceira. Thanks for watching, and we'll see you next time.